Hello, and welcome to the fifth episode of Raising Capital 101, where we will discuss the ins and outs of raising capital, what to do and what not to do if you're planning to get some investors. I'm Tom Voekler, and I'm joined today by my colleagues Rhys James, John Watson, and Mehanna Borostyan.
We want to thank each and every one of you who have listened to any of our podcasts to date, and we appreciate any questions, feedback, or anything you'd like us to talk about. We will take those suggestions and hopefully incorporate some of the questions in some later podcasts as appropriate. Today, we're going to build on our most recent podcast, episode 4, where we talked about the relevant laws that impact and regulate capital raising. And we're going to look at kind of the fundamental differences when you're doing a private versus a public securities offering. So, Rhys, probably you and I could talk a little bit, given our experience on a lot of different types of offerings, and we'll kind of talk about 3 buckets. We'll talk about, private placements. We'll talk about Reg A. And we'll talk about what I would call, true public, whether it's a non-traded or a listed product. And we're going to talk about the timing involved in those, and then we'll probably hit on some of the costs, which I know we hit last time, but we can go into a little greater detail. So if we're doing a Reg D, what do you kind of see the timing and how important it is to work with the issuer to be able to get a private placement out on the street?
Sure. Well, there's a limited regulatory component to the preparation and distribution of a private placement memorandum for a Reg D offering. So the primary drivers of the timing for a Reg D offering become the pace at which the issuer and its counsel can design the securities and structure the offering and create the disclosure and operative documents for the securities offer. So the biggest key then becomes the issuer's preparation to deliver and work with its counsel to deliver the information necessary to create the disclosure documents and to create the operative documents for the security to be offered. The more legwork and cooperative an issuer is with its counsel and other third-party providers like broker-dealers and third-party due diligence, custodians, and other folks in the offering process, the faster that will go for the issuer. I think a well-prepared issuer can get an offering from beginning to draft with legal counsel to on the street in 60 days, maybe a little less if it's a type of product or business for which the issuer or sponsor, where sponsor is an entity that often creates investment products, something that they've done before. I think you can even go a little faster than the 60 days. But ultimately, the timing really relates back to the issuer's preparation and cooperation in the delivery of information and structuring of the offer.
Yeah, and I think I want to make clear 2 things here. One is when we are putting a private placement memorandum, and not disparaging any other counsel out there, but when we undertake to develop this product with the issuers, these PPMs have a lot of disclosure in them. They have material information on the management, on who the sponsor is, prior history of the sponsor, experience of the sponsor, experience of the major executives. We talk about the material risks involved in both the investment and the business plan for the entity or sponsor. There is a lot that goes into these documents. And so what you say is right on point, which is the legwork and the ability to kind of formulate all this, because some of it is not just legal. Some of it is the business plan underlying the securities. And I think the other key point here is that if you are going through a distribution platform, retail broker dealers or the like, there are other hoops sometimes that you need to go through, such as getting through compliance with the broker dealer or going through a third-party due diligence process, in which case the documents that you felt were close to final may still need some tweaking and some negotiating, which may add a week or 2 to the process. But I completely agree with your timing. I think if we're talking cost, we're talking in the neighborhood somewhere of like a $25,000 to $100,000 engagement. Really goes to what Rhys was saying, the complexity of the security and the complexity of what the sponsor, issuer, project, whatever you want to call it, is. If you have multi-layers of fundraising, if you have multiple projects that need to be described, if you have joint venture partners, if you have complex promote structures that are the payout on the securities, there are multiple layers of disclosure that each of those could entail. And Rhys, I think what you were talking about before, the complexity of securities is very important here as well.
Sure. So I think that there's some other aspects that can take more time, take more cost. For example, if you're going to, and this goes to the complexity of security, if you are trying to develop a more unique tax structure or security structure, often, we'll do private REITs, and they are going to be on the upper side, if not over that, $25,000 to $100,000 estimate for a private offering, just because of the complexity of developing, structuring, and launching a REIT offering. That's a real estate investment trust under the tax code. So there are a number of factors, but ultimately that private offering is still going to be an issuer, a sponsor's quickest and cheapest path to market almost all the time versus a public offering of any type.
Great segue. Let's go into Reg A first. We have a lot of experience here at the firm conducting quite a few Reg A's. So we had some interesting deals on timing, whether that's from an SEC side or maybe even a FINRA side. You want to take us through some of what your thoughts on timing on Regulation A could be?
Sure. In Reg A, timing or any deal timing can be affected by one of the parties involved. Now in private deals, you don't have regulators, but in public deals, you do. But one of the parties involved having substantive critiques, substantive issues, something that needs to be resolved on the offering. So any of these timing estimates that we're delivering here is making the assumption that there's not some kind of major substantive issue that must be resolved in an offering. So with that said, a Reg A is really public company light. It comes with its own offering statement, filing requirement with the SEC that has a covenant and response process, just like a registration statement. If you become a qualified Regulation A issuer, you end up in a reporting regime, not just like an entity under the Exchange Act, but on a much more limited basis than on the Exchange Act. But still, you're going to have some reporting obligations that you wouldn't have in a private offering. So Reg A, like I said, requires a filing with the SEC called an offering statement that has a prescribed form of how you have to disclose the material information surrounding your business, your personnel, and the securities that you're going to offer and how you're going to offer them. The SEC will review that, will comment on it, and you're going to have to comply with those comments and finish them before you can go qualify. In addition, if you listen to the prior podcast, you'll know that if you're using a broker-dealer in a Reg A offering, then the compensation that you're paying that broker-dealer is going to have to go through FINRA corporate finance review and be approved prior to when your offering can become qualified with the SEC. Now, there are two tiers of Regulation A offerings. There's tier one that is capped out at $20 million in a rolling 12-month period. That's the most you can raise under tier one in any rolling 12 months. And then there's tier two, which is capped out at $75 million in any rolling 12-month period. I think without exception, we have recommended and our clients have done tier two offerings. The primary driver, really the key driver to this, is that tier two offerings receive blue sky preemption, meaning that you don't have to go and do registration in each and every state jurisdiction where you want to offer your securities. Rather, you're making a notice filing that is conceptually similar to the notice filings you make for Reg D. There's some process differences that are important, but the key takeaway is you're not having to go through registration with 50 mini SECs. If you do a tier one offering, you don't get that blue sky preemption. The con to the tier two, if you want to call it this, is that you are SEC required to provide audited financials in a tier two. And you're also going to be required to engage in the reporting I mentioned earlier. That said, if you were to do a tier one, the overwhelming likelihood is you end up having to do audited financials anyway, because many of the states require them for their registration process. So you're not really losing a lot on the audit and reporting side by going to tier two. The other piece of tier two is that you have some limitations on who you can issue to, but they're pretty broad. You can issue to any accredited investor, or you can issue to any non-accredited investor who represents to you, the issuer, that they're not investing an amount in you that is equal to more than the greater of 10% of their current net worth or 10% of their most recent taxable year's net income. So it's a pretty broad base of folks that can invest on the not accredited side, as well as all accredited investors in a tier two Reg A. Coming back to timing and cost. So if we talk about a private placement memorandum getting to the street in 60 days, that 60 days would be the period in a Reg A where you are developing the security that you're going to offer and creating the offering statement and including the disclosure, and also making sure that you have the audited financials that are necessary for Reg A. One very important preliminary step for an issuer considering a Reg A is finding an auditor and figuring out how long it's going to take to get their financials in order to become audited. Because for some folks, that can take 6 months. So that's a critical first step that an issuer must take. But once you pull the trigger with legal counsel and start that process, then you're putting your documents together and getting through that initial 30 to 60 day period to get those docs together. And then once you've done that, you file them with the SEC. And the SEC has 30 days to review and comment on your file. If it's your first time through as a sponsor or an issuer with a Reg A with the SEC, the likelihood is you will receive comments, probably several of them. And then after that, the pace of how quickly you go through the SEC will depend on how quickly you as the issuer and your counsel, us, can respond to those comments. The faster you turn things back to the SEC, the faster that you can progress towards qualification. So as a rough estimate, I'd say that, again, assuming that there are no significant substantive issues, you're probably talking about 75 days from when you make your first filing to when you get qualified with the SEC. If you're a sponsor that has done multiple Reg As or an issuer that has done multiple Reg As, that period may be significantly less. And you also may potentially get a limited or no review from the commission, allowing you to get through much faster. Cost-wise, on an initial Reg A for what I'll call a fairly straightforward product and offering, probably for the SEC qualification, somewhere in the neighborhood of $100,000 to $150,000. Onto that, you're going to add costs related to making legal costs, that is, relating to making blue sky filings in all 50 states, which is roughly $25,000 to $30,000. You also have about that same amount in filing fees to pay to the state securities commissioners and other regulators. And then you've also got costs associated with your auditing and accounting. Again, I keep saying this, but depending upon your complexity, those accounting costs may be $25,000. They may be $7,500,000. So all in, getting that initial Reg A off the ground on the legal, accounting, and regulatory side, $250,000, maybe a little bit more.
Yeah, I think that's a great analysis, because now, if you take that and you extrapolate exactly what you said, but take it to a public registration, you are adding complexity to a similar type filing regime. And you are also adding accounting requirements and additional disclosure requirements. If you layer in an exchange, you've got to add some charters that are required by the exchanges and things like that. So you are likely not necessarily extending your period of time with the SEC, although they do tend to be a little more detailed in their comments than they have been under Regulation A. I think it's been interesting the last couple of years for us here in the practice that the state government regulatory organizations have not been exempt from the hiring fluctuations, the great resignations, and the like during COVID. And the SEC did have a lot of staffing issues, as well did FINRA. And it was seen in their response times. It was seen in their ability to effectively manage large workloads. And so I think that timing difference hopefully was a one-time and getting better thing. But you are probably looking at a 9-month process in a public registration just because the complexity of getting the initial documents together may be even more than in a Reg A. And FINRA obviously compounds this because at the same time, you have to go through what Rhys described as a no objection letter process. Costs obviously go up when you're adding longer periods of time and more disclosure. Pulling more documents, more layers of documents. There is more complex governance over public entities. You are probably 2 or 3 times what you are in a Regulation A type setting. So I think these are interesting things for people to consider when they're looking at what do I want to do to raise capital. Cost is always important to people, and timing is obviously very important to people. But I think there are other considerations that have to be taken into play when you're looking at what is right. Mehanna, do you have any thoughts on other things people may be thinking about?
Yeah, definitely. I think, and we touched on this in the last podcast, but one of the major decisions that founders and companies have to face when wanting to raise capital and deciding between a private or a public offering is the level of control that they want over their company and the way that it is run and what they can do. Specifically, if you go public, or you're trading on those stock exchanges, you're going to need a board of directors that are primarily independent. And those board of directors have to manage the company and regulate the company in a way that provides the most security and the best outcomes for investors, not necessarily that first founder or those first couple partners that started the company. Other examples of lack of control is you have to have committees established. These are audit committees, compensation committees, things like that. You have to face regulations that you wouldn't otherwise have to face, like Regulation FD, and those require more additional disclosures that wouldn't normally be public information. So these are just some of the examples of things that I think when you're at this crossroads of, do I want to go public or do I want to make a public offering or stay private? That control aspect is front of mind, I think, for a lot of companies and a lot of founders who have started something that's successful and that they think can raise some sort of capital and can bring in other investors, and whether they want to control that process and control their company in the end.
Yeah, blood, sweat, and tears, very important. I think the other thing that issuers have considered is competitive control as well. So if you are doing something that you feel a public type disclosure document may give away too many trade secrets, may give away the secret sauce, whatever that is, and you think that being able to maybe operate under a less onerous disclosure regime of a private placement or maybe even a Reg A could be the way to go with Reg A. And I don't think we can spend much time on this. We'll probably have a whole podcast on Reg A, but you can do an initial confidential filing so that you can test the market and see if you're really going to raise capital and kind of get a head start on knowing if the capital will be there before you disclose to the market what you're doing. I think these are very important. Do you have anything, John, that people probably consider when they're looking at this?
With respect to what you're just saying with the audience of investors you're trying to target, certain private offerings, you can generally solicit your investors and some you can't. So if you have an established network of investors that you know are interested in investing with you, that'll inform your decision whether, for instance, you're going with a 506B or a 506C offering. So your experience with your investors can also dictate which direction you go.
Yeah, so I mean, you are definitely the most limited in a private placement with the accredited.
Right.
For those of you on the podcast, those are net worth requirements. There's other thresholds if you want to be a qualified purchaser or for other types of investments. So you're going to be limited in the pool of investors because you can only have a certain number of investors until you become subject to the public reporting requirements. So depending on how much each of those investors is willing to put into your capital raise, you're going to be limited overall, generally, how much you can raise. Obviously, Reg A, you have a firm limit on what you can raise in the 12-month period, like Rhys said. And then on the public side, really the sky is the limit as to what can be raised. The question there is, do you have the market support? Are people interested in that? And do you have the investment banking support? Again, all that will probably cost some money. Rhys, do you have any other things you think people consider between public and private?
No, I think we hit all the big ones here.
Yeah, I think we really did. This is great. I'd like to thank Rhys, John, Mehanna for being with us today.
That'll wrap up today's discussion. We hope you understand a little bit more about your options with regards to public and private offerings. Each situation is different, and each can require capital for different reasons with specific timeframes and cost structures. If you have any questions or suggestions for future episodes, please contact me. You can also visit our securities and corporate governance and REITs web pages at williamsmullen.com. There you can find out more about our team as well as legal alerts. And finally, be sure to subscribe to this podcast to be notified when our next episode posts. Thanks for listening. Until next time.